So I'm assuming we need to be in PrimeGov.
Yes.
Yes, please.
I'm having a very difficult time getting there.
Okay.
Okay, does it look like I'm in?
Yes, ma'am, we can see you.
Excellent, thank you.
You made me nervous, Laura. I thought I was in, but then I had so many folders open, I couldn't find it. So
That happened to me too. That's what happened is I was trying to open it and it was opening behind something else that I had open. So that's why I couldn't see it. Now I probably have 3 versions of PrimeGov open, only one of the meeting though.
well, I have 10 o'clock. So we'll start this meeting. First, though, I need to make a brief statement. This meeting is taking place over a video conference, and the video conference is disconnected anytime during the meeting. The meeting shall be stopped and reconvene once the video connection is restored. Communication is unable to be restored within 15 minutes. Items remaining for consideration will be continued today, May 10th, 2021 at 2 p.m. via video conference. And with that, I will call the meeting to order. And our first item is a resolution commending Ted Carlton for his service to the Oklahoma City Post-Employment Benefit. I have the resolution right here, and I would ask the clerk to read the resolution, please.
Whereas Mr. Carlton joined the Oklahoma City Police Department on July 30th, 1971. And whereas Mr. Carlton served the city of Oklahoma City for 35 years and retired as a major on August 8, 2006. And whereas Mr. Carlton was one of the original appointees to the Oklahoma City Post-Employment Benefits Trust on June 17, 2008. And whereas Mr. Carlton served on the Oklahoma City Post-Employment Benefits Trust for 13 years. And whereas Mr. Carlton helped establish and continually improve the Oklahoma City Post-Employment Benefits Trust investment policy. And whereas Mr. Carlton served on multiple request for proposal committees, ensuring the Oklahoma City Post-Employment Benefits Trust selected high-quality service providers. And whereas Mr. Carlton attended numerous Oklahoma Public Fund trustee education conferences to gain knowledge to aid in the improvement of the Oklahoma City Post-Employment Benefits Trust. Now therefore be it resolved by the trustees of the Oklahoma City Post-Employment Benefits Trust that they do hereby commend Ted Carlton for the service and dedication that he has provided to the Oklahoma City Post-Employment Benefits Trust.
All right. I'll seek a motion and a second for this, and then we can have some discussion. Got a move by Amy Madera.
I'll second it.
Seconded by Neil Garrison. Please record your vote. Well, I'd just like to say I really appreciate Ted and his diligence on this trust over so many years, and appreciated his friendship when I came onto this trust a couple of years ago. And I just want to thank you for his service as a police officer and thank you for his service here on this trust.
So, Brent, I would like to follow up on that just a little bit. Is Ted on the line today? I don't
believe so.
I don't see him in our meeting, but I did want to, as the only other, founding member of the OPEB Trust, I just wanted to thank him for his service to the trust, long service. And it was many days of driving a long way to come to a meeting and make a difference, though, when you think about how far we've come in terms of preserving our retirees' health benefits for the long term. It's really remarkable. And I just wanted to express my appreciation for Ted being in on the beginning of that process, because it must have seemed like a very big hill to climb.
And Mr. Chair, I'd also like to comment. I second everything that everyone has said. I was also a founding member on the trust, and Ted and I served the entire time together. And so I absolutely want to thank him for serving. And it has been an honor I sat right beside him, so it was an honor to sit next to him and make some important and critical decisions for the post-employment benefits for the retirees. So thank you.
Diana, I forgot you were back. You're back. Yay.
Hey, Laura.
I was going to recognize her as soon as we got finished with that. So.
Awesome.
So, all right. So if you'll record your vote.
I vote yes.
I vote yes. I'm not able to get a voting screen.
And it passes 5-0. And with that, I'd just like to recognize thank you. Go ahead, Neil. Did you have something you wanted to say?
Yeah. Is this something that we're going to get to Ted by email or mail or?
Yeah, we will mail him the resolution. We will mail that to him. So.
Okay.
Yes, sir. All right. So with that, I would like to recognize our newest trustee, Ms. Diana Berry. I know she's not, most of us are familiar with her. So welcome, Diana. We're glad to have you and look forward to working with you.
Thank you. I'm happy to be back.
All right. So item number 3 is approve the minutes of the February 8th, 2021 meeting. I need a motion and a second. And a motion and a second. Please record your votes.
I vote yes.
I also vote yes.
The item is approved unanimously. Item number 4 is approve the minutes of the April 5th, 2021 special meeting of the Investment Committee. A motion and a second. Wait on a second. There we go. Please record your vote.
I vote yes.
And it passes unanimously. Item number 5 is approve the minutes of the April 5th, 2020 special meeting. A motion and a second. Please record your vote.
I vote yes.
And that passes unanimously. Now we're to item 6, was a presentation of the investment performance review period for the period ending March 31st, 2021. And we have Doug Anderson with us here from ANCO. So Doug, take it away.
Good morning, everyone. Let's see. I'm going to share the screen and I'm going to go straight from the packet here. Let's see. I was previewing the reports myself this morning. There we are. In your board packet, you will find a series of reports. The one I want to spend the most time on is the March 31, 2021 report. It's great to see everyone. I'm sad to see Ted go, but as long as his replacement is Diana, it gives me a great deal of confidence in the continuity, which I think is critical for investments like this, and not only for pension funds, et cetera, but I think OPEB trusts are sort of a unique type of asset, and to have that, what I'll call founders or founding members, founding trustees knowledge on this is incredibly helpful. So those of you who were founders, please don't go anywhere for a while. It's very helpful in informing the decisions that we make here, because this is not a pension or it is not an endowment or a foundation. These assets are unique in the way that we treat them, and unique in the incredible benefit that it gives your retirees, which I think is something I remind myself about all the time. Diana or Trustee Barry, welcome back. It's great to see you and look forward to working with you. Pardon?
Thank you. I said, thank you. Same here.
So we'll go through the report, and the good news is that returns have been very strong in most parts of the portfolio. We've seen a tremendous return for equities here. This is for the quarter. You can see the non-US equities. Non-US equities are up, 3.5% or 2.3% for emerging markets for the quarter. US equities up a tremendously strong 6% for large caps, 12.7% for small caps. Only thing that did not do well during the quarter was bonds, and we have relatively low allocation to fixed income. Now, for the 1 year, and just put it in perspective, March 23rd of 2020 was the low point in the COVID market crash. So what we're showing in this report is April 1 of 2020 all the way through March 31st. And what you'll see is some of the best returns that I've seen in over a decade, and probably I'm thinking some of the best returns that we will ever see from the equity markets. So looking at the trailing 1 year, you can see that our international equity indexes is the top set here, the red and pink ones, or the maroon and pink ones, 49%, 44.6% for developed markets, and 58% for emerging. Now that sounds great, but when you look at it versus US markets, it's even, it pales in comparison. The S&P 500, which we talked about extensively last year being the best place in the market because of Amazon, because Microsoft, they own Teams, because of all of these big companies that really benefited from the stay-at-home trade. You can see for the year we're up 56.4, but if you look down to the Russell 2000, it was up 94.8%, which is amazing. And really a great deal of that return came in the fourth quarter of last year, specifically after November 9th, which was when the first vaccine was approved for use. And after that, we switched from mega cap US companies or large cap US companies down to small caps, which had been largely punished during the COVID lockdowns. So you see down here, bonds were modest for the most part, but you'll see that investment grade bonds and even TIPS performed well, and those are inflation protected bonds. So quickly going through US equities, value outperformed during the quarter. Value has now been close to growth over the last year, which is a tremendous change. And just looking at what caused that change is the first quarter of this year, Russell 2000 value. So these are small value companies. And when I say value in today's world, that means small banks, small insurance companies, energy companies, and a couple of other names that you'll undoubtedly have heard of recently. But they were up 21% during the first quarter. That followed up a really strong fourth quarter of last year return. And then the growth indexes are very modest compared to those. But it's this switch that we've seen recently where value is outperforming growth, and it's even pulled them level or even slightly ahead, despite lagging most of last year. Some things to point out here. Technology was great. Consumer staples were good last year. But if you look for the quarter and the year, for consumer discretionary on the small cap side was up 200%. Again, this gives you a view of how dramatically the economy changed over the last year. If things are going smoothly, if we have no big disruptions to the economy, no changes on the way that people are living and doing business, you don't see 200% returns in 1 year. However, when you have something as dramatic as we saw last year, you can see changes like that. Energy now up finally. And I think that what we're seeing in energy is going to be a steady rise in oil prices. I'm sure that a lot of us have seen, and probably a little bit too familiar, the Colonial Pipeline being shut down over the weekend. And if that continues more than 5 or 6 days, the East Coast is going to have real problems with gasoline. And you're going to expect to see prices rise across the country. Some things that I'm not, that doesn't make a lot of sense to me right now is real estate, positive returns of last year. I think there's an opportunity for real estate moving forward as we rotate back to working from offices, and also some disruption that we'll be able to take advantage of. So expect to hear a little bit more of that as we move through this year. I think it's an opportunity to invest in a changing market. What we'll see here, this is the top 10 weighted stocks: Apple, Microsoft, Amazon, Facebook, and this is Alphabet, so this is Google, and then Tesla are the 6 largest companies traded in the United States. And as we look here over to the top 10 small cap stocks, top 10 small cap stocks, you'll see that these are pretty different than they were a year ago too. So you have consumer discretionary, the top 2. Basically think of these as online gaming. Plug Power is a electronic vehicle play. This Darling Ingredients is another consumer staple. And then we go down to what we were all talking about at the end of the first quarter, GameStop. So that's still a big company out there. And just looking at the returns here, 5,323% return for one company. This is literally a 1 in a million opportunity, and don't feel bad that we weren't invested a lot into it. But it is interesting that looking over the last quarter, just where those individual stories are. And just to sort of reflect on how the markets have changed. Last year, it was index. This year, we're seeing a little bit more of individual companies and individual stories or narrative stocks performing in the marketplace. You'll look here for international, strong results across the board, across countries. And then as we go into fixed income, this is really an interesting area to be invested in right now, because bond prices go down when bond yields go up. And the thing that's probably driving bond yields higher right now is inflation. I'm sure we've all heard of lumber, steel, other raw material prices going up. And that's some folks think that is transitory because of the supply chain problems we had last year, because we didn't have workers. I heard somebody the other day saying that they were ordering some specialty bricks for a project, and this was a commercial project. And still to this day, the commercial brick making company said, your order is going to be late because we had a COVID shutdown this month. And that's why we're seeing continued supply chain disruptions, but that's a very small scale. A very large scale is probably going to be petroleum or other issues, lumber, like I said earlier. And then looking at bond returns here, or the yield curve, it has gotten a lot higher. It's still very low. What we should be paying a lot of attention to is this 10-year yield. If it keeps going higher and higher, that's a dramatic reduction or a dramatic increase in the price of money, which will probably lead to a dramatic decrease in economic activity. So out of all of these figures, the 10-year bond yield is one that I'm watching very, very carefully right now. Looking at this, page 10 of our report, the trailing one-year total return for this fund is 45.2%. We're obviously pleased with this. We're obviously very proud of this. A lot of the things that we've done over the last few years fed into this return here, but I want to caution everyone, this is not the return I expect year in and year out. This is a once in a generation issue. And when I say once in a generation, I honestly don't expect to see returns this high for diversified portfolios, unless I work until I'm 100 years old, honestly. It's really that rare that we see something so strong. Grateful, yes. Does this help us financially? Yes. Is this something that we can build year in and year out? No, it's not. I just don't think that it's realistic to expect this going forward. Now, where the returns, here's some interesting figures here. The ending market value of the OPEB trust was $88.7 million. This does not include about $2 million that's held outside for reasonable cash flow in inputs and outputs. But thinking back to this, that the beginning market value, and I'm going to go back to the founding of this trust, beginning market value is $6 million. We have contributed 81, which is a lot. Withdrawals, we have pulled out almost $38 million, and the gains have been 39.4. Now that's realized and unrealized. So a total return since its inception of 156%. And remember, we started out very slowly at the beginning because we were in the grips of the great financial crisis. We've had income in excess of the initial funding amount of the portfolio. So what I would say is that things are going very well. The net cash flow is $49 million, and the difference is going to be income and appreciation over since the inception of the fund. As asset allocation hasn't changed much. We have gradually increased equity because this is a very long-lived pool of assets. And honestly, right now, with interest rates as low as they are, I think that that's a major impediment to achieving our long-term results. Now, looking at the total return here, as of March 31, we had 63.4% in domestic equity. Core fixed income was 15%, international equity at 11%. Active duration, remember this is a hedging portfolio for us, and almost every occasion the equity market volatility has gone higher and impacted the fund. This portfolio has performed the opposite in a positive direction. And then our high yield fixed income at 2.4%. So during the quarter, we went from 84.4 million to 88.7 million, and we've gone even higher from there since the end of the quarter. Here's the allocation. Index fund is our largest, so we're going to participate in the winners of the index, the winners in a relative and an absolute sense. Small cap growth stock, you can see Causeway, our international value equity manager, Hotchkiss, our mid-cap value equity manager, bonds through the rest of this, and then our Vanguard mid-cap index at 6.2%. I'm going to skip over here just to show you some of the strength of the returns that we've seen. So the total fund composite net of fees was up 3.9% during the quarter, which outperformed all of the benchmarks. And that's also our year-to-date period. The trailing 1 year was up 45.16%, which ranked in the 3rd percentile. That means you beat 96% of all public plans in the 50 million to the 100 million universe. So we have you against funds that are roughly the same size. And looking at returns over the last 10 years, larger funds with more allocation to alternative, illiquid, high fee asset categories actually underperform smaller, simpler portfolios. And I think that's something that we should keep our eyes out and only invest in those things when it makes economic sense. But looking at the return here, 45.16 outperformed the policy index of 36.55 by a huge margin. We outperformed the median by almost 10%. And we outperformed our actuarial assumption of 7.5% by over 35%. And you see how this has impacted our 3-year when we're in the 12th percentile, our 5-year when we've compounded 11.89 when we're in the 2nd percentile, and then even our 7-year return, which we're in the 32nd percentile. So these returns are fantastic. Where we were strong over the trailing year, fixed income, you can see, unfortunately, we were at the 100th percentile. That was 25% of our portfolio. Looking at it over this 1-year trailing period, there's one portfolio that pulled the rest of it down, and that's the Hoisington 30-year or the active duration portfolio. Now, over the beginning of the year last year, this was our best performer, but it holds only treasuries. It holds only long duration treasury bonds, and that's been hurt pretty badly over the last quarter. In fact, 30-year treasuries are in a bear market over the last year. Now, this is in sharp contrast to the Loomis sales portfolio, to the double line portfolio, and our high yield portfolio, which performed very well on a relative basis. But even with this 20% loss, the Hoisington portfolio still outperformed its benchmark in its peer universe over the last 3 years. This is a high volatility portfolio. We definitely don't want to have our entire fixed income allocation here, but when fixed income is really needed, so when equity markets are down, this is the one that provides most of the risk reduction. And again, these are unrealized losses. These are not realized losses. So if interest rates start to move lower, you're going to see pretty dramatic gains from here. Our total domestic equity portfolio, again, relatively simple structure. The total portfolio was up 70% for the last year. Where did those gains come from? The S&P was really strong at the beginning of last year, in the middle part of last year, and 44th percentile, it's up 56% for the trailing 1 year. The mid-cap index was up 70%, which is right in the middle of its peer universe, right on its benchmark. And really the one we've been waiting to perform for quite some time is this Hotchkiss and Wiley mid-cap value. Again, up 142%. I mean, it takes a tremendous amount of patience and hard work to get a portfolio to perform like this. And sometimes you have to wade through a few bad years where the portfolio is not recognized by the rest of the marketplace. And I had a call with Stan Major, the portfolio manager, last week. I actually had a couple of calls with them, and they haven't changed the portfolio very much. It's still invested in the same companies that they thought were undervalued last year. They have sold a few of them, but the portfolio still is remarkably cheap compared to its peers out there. Again, 142%. You can see that that really contributed significantly to the total return over the last year. Our small cap portfolio, small cap growth was up 82%. And we're comfortable with that. They're not investing in what I would say the most risky bond or most risky stocks are out there on the small cap growth side. And we're okay with that. And then our Causeway International Value also had a very strong return over the last year, up 65%. So that's where the returns came from. I'm going to flip through a few other pages here. I just want to give us a little patience here on the Hoisington portfolio. I know it was looking back right now, it's pretty rough. But in the year 2020, they were up 20%. For the year 2019, they were up 17%. Again, outperforming the vast majority of their peer universe. And then in 2018, they're down 3.75%. 2017, you can see the pattern here. They're either the very highest or the very lowest. And we can use that to allocate to this portfolio from time to time. Looking at our I'm going to go through these. You can go through those at your own time. You can recognize that we have tight tracking where we have index funds. The bond portfolios are doing well, with the exception of Hoisington, which we think will come back. It has in the past when we've seen it like this. But just looking at one thing here is our correlation matrix. We have negative correlated assets, and those are bonds. In fact, Hoisington is negatively correlated even to the other bond portfolios. So we really like that. It's negatively correlated to the total fund as well. Hotchkiss and Wiley, want to continue to leave them on alert. Great year, but we'd like to get the 3-year return up above median in its peer universe. And the Causeway portfolio, again, it's the very same story. Value managers, tough time over the last 10 years, actually. I like to see the extended returns go above benchmark and peer universe. And then here are fees. Fees are very, very important. We've had a lot of discussions about this. I'm going to continue to go to all of these managers on a relatively frequent basis to make sure that we're in the lowest fee share class in all of these. I think next time we get together, I'll probably be able to find a couple of more that have reduced or have offering lower cost share classes. It's kind of a fight to the bottom right now. And I'll continue to bring this up because it is a reasonable area to reduce the costs of the management of this portfolio. And then here's some new tables that we put in that are compliance checklists. And most of these are yeses. There are a few nos, but we understand what's going on there. And these are the individual manager checklists. So with that being said, I'm going to finish up on one thing. I know we have a relatively high allocation to equities. This is our asset allocation compliance table. And one of the things that we use to manage this risk is these columns, or these bars, if you will, the gray bars, show us what the allowable policy limits are for all of these asset classes. So for fixed income, the lowest allocation for core fixed income is 12%, but the maximum is 65. You can see it is not symmetrical here, meaning we can have up to 65% fixed income if we would like. Now, the other side of that is domestic equity. And we can have our target allocation to domestic equity is 60%. We can go up to 65%. But beyond that, we're compelled by policy to rebalance. And this manages the overall allocation to equity, which is the main source of volatility. So by having this asymmetric allowance by investment policy, it caps the maximum on equities much closer than it does on the lower band. And that's remember, asset allocation is our primary long-term risk control and also our primary driver of total returns. What this does is that our cap on equities, domestic equities, is relatively close, forces us to take profits. That's the way I want everybody to think about it. If we go from 60% up to 65% in domestic equities because we've had good returns, it forces us to take profits. That's all it says. And it forces us to take profits much sooner than we would have to in these other asset categories. So with that being said, I'm open to any questions on the quarterly report. We have a few others that we need to run through, but it was such a great quarter. I want to make sure that any questions are answered right now on this report.
Any questions for Doug? Here on item 6. All right, we don't have to act on this one, so we'll go to item 7. To receive the monthly investment flash reports for January 31st, February 28th, March 31st, and April 30th, 2021.
All right, I'm going to keep in control here. And if I may, Mr. Chairman, can I just go over a couple of figures here?
Sure.
Looking at the trailing 1-year return as we roll months on and roll months off is really interesting. So for the year ended January 31st of this year, remember when I showed the March 31, it was a 45% trailing 1-year return. So that included, as of January, includes February of last year through January of this year. 15% is the return. And as we move through this, we go to February, that trailing 1-year return goes to 25%. And as we move into March of this year, which we just looked at, it goes up to 45. So we went from 15% for the year ended January, 25% for the year ended February, to 45% for the year ended March. It's just amazing to see what happens when you add on a good month, but even more amazing what happens when you take off those poor months we had last year. And then the one thing for the February report here, that year is 37%. And one thing I'd like to highlight is we had a fund change in the month of February, or in the month of April. We changed from the Vanguard Admiral Class 500 to the Fidelity 500 Index Fund. And that was done to reduce overall costs. Vanguard and Fidelity, as we know, are in a fight for fees. And Fidelity is offering this for 1.5 basis points, whereas the Vanguard option we were in was 3.5 basis points. But when you're talking about $33 million, that's a reasonable cost. And Diana, I think that this is something you'll be interested in if you carry the same interest as you used to, looking at the reduction in costs across the index fund space out there. So beyond that, good news here is that for the month of April, we were again positive. And the market value is at $93.9 million over that time. So just amazing run of performance here. And now I'm going to stop sharing my screen and happy to answer any questions on those reports as well.
Any questions for Doug?
No questions, Mr. Chair. Doug, great presentation. Thank you so much for the information, especially when it's that good.
It's a good month to be back on the board, isn't it?
Yes, it is. Yes, it is. Absolutely.
Doug, I will tell you, I'm a little alarmed. You went from 40-some% down to 37-some%. So I don't like the trend there. So,
like I said,
I want to ask, is it 91.3 million? Is that what you said our ending balance is?
93.4, I believe.
Okay, thank you.
Thank you.
well, with that, I would like to, if I could get a motion, a second to receive the monthly flash reports. We have a
I second.
motion and a second. Please record your vote.
I vote yes.
Thank you, Neil. Passes unanimously. All right. Thank you, Doug. Thank you for all your work.
Thank you very much, Mr. Chair and trustees.
All right. Item 8, discussion and consider approval of additional asset allocations to the portfolio. We do not have any, so we will go to item number 9. No action is necessary for that one. Item number 9 is the external audit contract and addendum between the Oklahoma City Public Post-Employment Benefits Trust and Allen, Gibbs and Gulick, AGH, is for audit year of our fiscal year 2021. And I think Mr. Boggs has some comments on this item.
Yes, this is just the renewal of the audit contract. The original contract was a 5-year contract with an option for 2 one-year renewals. This is the first of the 2 one-year renewals. It is mentioned in there that there's an addendum. It was related to a HIPAA omnibus final rule. And so that's what that addendum is there for. And we also have Amy Lucas from Accounting Services on the line if you have any specific questions about the audit contract.
With that, I'll entertain a motion. Motion and a second. Please record your vote.
I vote yes.
Neil. And it passes unanimously. All right. Item number 10. It's agreement between the Oklahoma City Post-Employment Benefits Trust and the BOK NA doing business as Bank of Oklahoma for custody services for a term of 1 year with an option to renew for 4 one-year term. Mr. Boggs.
Yes, this is the result of back in August, there was a request for proposal for custody bank services the selected vendor for that was Bank of Oklahoma. So they will again be our custodian going forward. This is a 1-year term with an option for 4 one-year renewals. Based on the current assets that we have, we should see a savings in the fiscal year of approximately $5,800. So the fees are lower going forward in this contract. I say approximately because it is based on the fees, the assets managed, and as Doug's report shown, that has increased, and so we can't give you a exact amount, but it will be based on that. But it is a lower rate going forward. I would like to say that on the actual memo, there is a small typo that it says that the 1-year term would be commencing May 10th, 2020. That should be 2021 as of today's date. I just wanted to point that out on the memo, but we could happy to answer any questions that you might have related to the custody bank contract.
Thank you, Matt. Any questions for Matt? All right, well then if not, I will entertain a motion on item 10. A motion.
I second.
Neil seconds. Record your votes.
I vote yes.
Thank you, Neil. Passes unanimously. Item 11, it's amendment to actuarial contract between the Oklahoma City Post-Employment Benefits Trust and Nyhart. Mr. Boggs.
Yes, this is an amendment to Section 4 of our existing contract to provide a payment of additional services related to the estimation of various scenarios in plan design changes to retiree benefits. And if you do have any additional questions, we do have Jason Long from Human Resources on the line that can assist with that.
Any questions for Matt or Jason? With none, I would entertain a motion. Moved and seconded. Record your vote.
I vote yes.
All right, thank you, Neil. Passes unanimously. Now we're to item 12, fiscal year 2022 annual budget, establishing revenue and expenditure budgets.
Yes, good morning. I'm Doug Dowler. I'm the Assistant Finance Director and Budget Director for the city, and I'll be kind of walking through the budget that you have before you, and maybe I'll go ahead and just share my screen just so we're looking at the same thing as I'm talking through that. All right, hopefully you can see that this is the attachment to the agenda item that's before you. The budget for fiscal year 22 is $29.2 million. That's an increase of about $932,000.
Doug, we're not seeing anything right.
Oh, you're not, okay, let's see. It says that I am sharing the screen, but apparently.
On our screen too, it says Doug Dowler has started screen sharing, but that's all we get.
Okay, maybe I am not authorized to share the screen here on.
No, it says double click to enter full screen mode, but
There we go.
yay.
I don't know what you did, Doug, but thank you.
I hovered over the little thing and it kind of moved. I don't know. Anyway. So $29.2 million is the budget that we're looking at for FY22. It's a slight increase, about $900,000 over FY21. You'll see that retiree contributions for the indemnity plan are down a little bit. Again, it's really related to enrollment. We have a slightly smaller population for FY22 than we did in FY21, but we also have more people that are now over 65 versus under 65. And so moving into that Medicare eligible category reduces our costs. And so we do have an increase in the HMO contribution. Again, more people are in the HMO plan than they were in the current year. We've had a slight shift from indemnity to HMO. The rates went up in both indemnity and HMO coverage for our retirees. But again, that kind of change in the distribution of participants is kind of what's driving those changes there. We did increase the general fund budgeted subsidy to $13.3 million. And this restores the city putting in more than the pay-as-you-go amount. So this is estimated to be another $1 million contribution that would be added to reserves to help get us towards, again, getting a higher level of funding towards our liability. You can see here the expenditures really relate directly to those revenues. The city is paying half of the cost for retirees. The retirees are paying the other half. And so you'll see basically just a doubling of those costs for indemnity, HMO. Dental, life, and vision do have a different allocation. You can see, for example, vision is 100% paid for by the retiree. The city does not subsidize vision costs, but again, that's a relatively small piece of the budget. As began a few years ago, COTPA is now a piece of the city's retiree benefit plan. So they are also supporting, they're contributing to the trust. And one thing I would note here at the bottom, we expect to end this year at $71.6 million, but that is before the, I don't know, for lack of a better word, incredible investment returns that we've seen recently that was presented earlier in the meeting. So obviously this number is going to be higher than this at year end, again, because of those high investment returns. So anyway, we're expecting next year to, based on the city's additional contribution and some interest earnings and those sorts of things, that about $3.5 million increase in contributions to the reserve fund for OPEB. And so again, looks to be we're in a good position moving forward. As Mr. Anderson noted, the funding level on the trust has come along significantly since we began here. And so I'd be happy to take any questions after, assuming you all approve the trust budget, then we also will present this to council for them to receive as well, just so they're aware of the budget going forward. And with that, I'd be happy to answer any questions you might have.
Mr. Chair, I have a question.
Okay, go ahead.
Doug, what is the percentage of the cost is the COTPA subsidy?
Let me see if I can Find that here. I do not have that handy in front of me. I'll have to get that and provide that to you. I'm sorry, I don't have that here.
Okay, thank you.
I would note one other thing that I forgot to mention under professional services on the expenses. The biggest portion of that, about 356,000, is for retirees to have access to the city's clinic that is here adjacent to the city campus here in the Arts District garage. That's the biggest piece of that professional services expenses to allow our retirees to have access to the clinic.
And Doug, when you provide that information on COTPA in terms of the cost, the percentage contribution or that subsidy, what percentage of the cost it is, could you include also the professional services and other charges?
Okay, the breakdown of that, you bet. Yeah.
Thank you.
All right, any other questions for Doug? All right, seeing none, I would entertain a motion. A motion, a second. Please record your vote.
I vote yes.
The item passes unanimously. Thank you, Doug. Item 13 is to ratify the claims listing. Are there any questions for Matt regarding the claims? If there are not, I would entertain a motion. Got a motion and a second. Please record your votes.
I vote yes.
Thank you, Neil. And it passes unanimously. Now we have item 15. Is this like the longest agenda we've ever had? Item 15. Reports, comments from trustees, staff, and interested party. I believe Matt had something he would like to say.
Yes, as Doug mentioned, Doug Anderson, I should say, since we have two Dougs presenting this morning. Doug Anderson in his investment presentation mentioned the move from Vanguard to Fidelity. That was one of the actions that was approved at the April 5th investment committee meeting. And one of the stipulations was that that was done in such a way that we had no loss due to market exposure. That was the specific request of the trust. And we were able to accomplish that. And I really wanted to thank Marcia Estes from Bank of Oklahoma and Doug Anderson from ANCO. They collaborated to make sure that we accomplished that. We had to do it over 2 days to make sure that there was no loss due to market exposure, but they were able to do that. And I just wanted to send my appreciation to Doug Anderson and Marcia Estes for their collaboration in accomplishing that. And from a staff perspective, we would also like to welcome Trustee Barry back to the Oklahoma City Post-Employment Benefits Trust. When I did speak with Trustee Carlton just about this, and I mentioned that you were going to be taking his place. His exact quote was, "I think the world of Diana Barry." So I thought I'd pass that along as well.
All right, well, thank you, Matt. And again, welcome back, Trustee Barry. So does anybody else, any of the other trustees or staff have any comments?
Mr. Chairman.
Yes.
I did want to mention that this will be our last virtual meeting for a while. We'll be going back to in-person meetings effective with our next meeting. I wanted to assure the trustees that we're taking every precaution available to us inside of the council chambers. And I think that they'll find the remodeled chambers quite comfortable. And we will be having cleaning protocols, mask protocols, all those sorts of things to ensure our health. But I did want to give you all a heads up about that and congratulate you all on not only surviving, but thriving in the age of virtual meetings.
All right. Well, thank you.
Yeah.
Yes.
Brent, I had a question too. on Diane Berry, getting her sworn in, is that something that's done in a face-to-face format?
I took care of that with Diana and had her sign the
Okay.
office.
Okay.
Yes.
Now, Neil, I am not opposed to having all of the pomp and circumstance at a future meeting, since I missed out on that. So if you guys want to, have this major reception for me, I am not opposed to that at all. Listen, I just wanted to say I am really happy to be back on the trust, serving with such phenomenal individuals. And thank you, Matt, for sharing the information from Ted. I also think the world of Ted. So just happy to be back and ready to get to work. And I'm actually looking forward to in-person meetings. I've done so many virtual meetings. I'm ready for in-person meetings.
I think you and Amy share that perspective.
Yes.
Amy,
All right. Well, since we're at the conclusion of our agenda item, I guess we are adjourned. So thank you. Thank you all.
Thank you
Have
all.
a great week.